దూరవిద్యా విధానంలో డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ దేశంలోనే మొట్టమొదటి సార్వత్రిక విశ్వవిద్యాలయం. దాదాపు 2.5 దశాబ్దాలుగా దూరవిద్యా విధానం ద్వారా కంప్యూటర్ కోర్సును అనుసంధానం చేస్తూ BA, BCom, BSc డిగ్రీ కోర్సులను అందిస్తోంది. పోస్ట్ గ్రాడ్యుయేషన్ స్థాయి, డిగ్రీ, డిప్లొమా స్థాయి కోర్సులను ఔత్సాహికులైన విద్యార్థులకు అందిస్తోంది. డెవలప్మెంట్ స్టడీస్లో సెంటర్ ఫర్ ఎకనామిక్స్ అండ్ సోషల్ స్టడీస్ ద్వారా MPhil, PhDతో పాటు విశ్వవిద్యాలయమే స్వయంగా దూర విద్యా విధాన అంశంపైన PhD వంటి పరిశోధన కోర్సులు ప్రవేశపెట్టింది. రాష్ట్ర వ్యాప్తంగా సుమారు 4.5 లక్షల మంది విద్యార్థులు ఈ విశ్వవిద్యాలయం నుంచి ఉన్నత విద్యావకాశాలు పొందుతున్నారు. డాక్టర్ బిఆర్ అంబేద్కర్ సార్వత్రిక విశ్వవిద్యాలయం స్థానికంగా స్వయం బోధనా పద్ధతిలో ముద్రణ రూపంలో రూపొందించిన కోర్స్ మెటీరియల్ అందిస్తోంది. కోర్స్ మెటీరియల్ అధ్యయనానికి సహకరించే విధంగా రేడియో, టెలివిజన్ పాఠ్యాంశాల ఆధారంగా కార్యక్రమాలు ప్రసారం చేస్తోంది. అధ్యయన కేంద్రాల ద్వారా ఏర్పాటు చేసే సలహా సంసర్గ తరగతులు, సైన్స్ ప్రాక్టికల్ సౌకర్యాలు విద్యార్థులకు స్వయం అధ్యయనానికి ఒక చక్కటి అవకాశం. ఇవి విద్యార్థి సమీపంలో ఉండే అధ్యయన కేంద్రం నుంచే పొందొచ్చు.
Good afternoon, viewers, and welcome to another program on business environment. My name is Narendranath. I'm a teacher at the Institute of Public Enterprise, Hyderabad. You may recall that in the previous program we had discussed at length the industrial policy of India. In today's program, we would be discussing 2 or 3 other policies, and amongst them, one would be the fiscal policy, the other would be the monetary policy, and in case time permits, we would also deliberate on the financial sector reforms. To discuss these issues, we have in our studios with us 2 teachers from Osmania University. We have Professor S.P. Satyanarayana, who is the Dean, Department of Commerce, Osmania University. We also have Dr. Patrick, who is a corporate trainer and who is a teacher in the Department of Commerce, Osmania University. Before we commence the program, I have an announcement to make. We would be discussing these issues for about 40 minutes, and the telephone lines in the studios would be opened during the last 20 minutes. In case any of the viewers, any of the students, any of the teachers, any of the professionals who are watching our program have any question to ask, you are advised to put a question very briefly and call us at 2703-1431. I'll repeat that, 2703-1431 or 2703-1432 or 2703-1433. In case you are calling from a cell phone, remember to prefix it with 040. Without any further ado, we'll get down to the issue at hand. As all of you know, not a day passes without some issue or the other being discussed as far as the economic reforms is concerned. And the issue is, what is fiscal policy? You will hear somebody talking about fiscal policy. Today it's SVS, that's SV Satyanarayana out here. Or somebody writes about fiscal policy. In order to demystify this, I would call upon Professor Satyanarayana to tell us what is fiscal policy, what are the elements of fiscal policy, what are the constituents of fiscal policy, who announces this, and what is the periodicity, Professor Satyanarayana, at which this fiscal policy is announced. Yes.
Thank you, Professor Narendranath. Though we are in a market economy, still the government is playing a big role in the economic growth and other aspects pertaining to the economy. Fiscal policy is one of the instruments used by the government to stimulate growth, increase employment or reduce the unemployment rate, and contain inflation. All these are the objectives of fiscal policy, and it is aimed at on one side revenue management, and on the other side expenditure management. So through government expenditure and government revenues, the aggregate demand in the country is influenced by the fiscal policy. So broad objective of fiscal policy is to stimulate growth if the country is in recession or slowdown. When the country or economy is facing slowdown, fiscal policy helps in stimulating the growth. We have seen from 2000 when we are in deep trouble, when the entire world is in recession, even in India, we adopted stimulus measures to improve the growth in the economy. Lot of measures were taken. Tax rates were reduced, excise duty was reduced, customs duty was reduced, and the objective was to stimulate the growth. And if the country, when the country is in facing inflation, problem of inflation, again fiscal policy will come into picture, and government can use this instrument to contain the inflation by reducing the expenditure. And thus the main objective of fiscal policy is to face the cyclical fluctuations in the economy. We can tackle them better if fiscal policy is correctly managed.
Would it be fair to say that the fiscal policy is announced only once in a year, and another term for the fiscal policy is the union budget?
There is no such thing as a term for fiscal policy, but usually the finance minister in his budget, he gives some target pertaining to the fiscal deficit. That gives an idea regarding the government tax policy and expenditure policy. For example, in the last budget, Chidambaram said that he wants to contain the fiscal deficit to 4.6% of the GDP, and they wanted to stick to that. So that means that government reduced the expenditure and concentrated on improving the tax collection. So this is what we have to understand. There is nothing like announcement of fiscal policy. It is only the intentions of the government pertaining to fiscal deficit that will explain how the fiscal policy of the government would be.
Thank you, Professor. So essentially what you are saying is the fiscal policy is about mobilizing revenue, managing certain expenditure, and somewhere or the other you told us that it might not be in balance, therefore we might have to go for debt management.
Yeah.
In the backdrop of this, Professor Patrick, could you tell us what are the various ways in which the finance minister could mobilize resources? What are the tax revenue? What is NTR or the non-tax revenue? Could you, for the benefit of our students, walk us through the various tax revenues and the non-tax revenues?
Thank you, sir. To continue from where Professor S.V. Satyanarayana has left, where he said about what is this fiscal policy about, it's to do with the government revenues and the expenditure. The revenue has got two sources. One is the tax revenue and other is the non-tax revenue. Under tax, we have the direct taxes and the indirect taxes. The simple difference between the direct and the indirect taxes is, under direct taxes, to whom it is administered and from whom it is collected is the same person. And under indirect, it is administered and collected differently. In the sense, let's say it is sales tax. The seller goes about paying it to the government, but it is collected from the buyer. And if you look at direct taxes, it includes corporate and the individual taxes. And among it, when you look at direct taxes, we talk about things which are governed under Income Tax Act of 1961, which includes income from salaries, income from house property, income from business or profession, capital gains, other sources. And sir has gone about giving a list of a few of these indirect taxes like excise, customs, octroi, and all other things that are there. And at times government goes about with receiving revenues from the kind of activities, services and goods it provides in the market. And at times it goes about with the disinvestment policy and fines, penalties and other things. Whatever things which do not come under the purview of tax, they come under the non-tax revenues of the government, sir.
I would like to add 2 or 3 issues to what Professor Patrick has explained. So here tax revenues, as he rightly pointed out, can be divided into tax and non-tax revenues, and the objectives of the government pertaining to tax is to widen the tax net. So after particularly economic reforms, the government has gone about widening the tax net, so bringing more people under the purview of tax. For example, introduction of service tax, it is one of the instruments which the government used to widen the tax net. Now every one of us, we are paying a service tax without our knowledge. For example, on cell phone, when you recharge cell phone, you are paying service tax. When you perform the marriage in your house, you are paying service tax. On every now the government has gone for a negative list of items. So that negative list contains the list on which the services tax is not levied. Otherwise, on all services government is levying the tax. So the objective of the government is to prune this list every year, and we may have a situation wherein after another 5 or 10 years we may not have the negative list. It means that all the services will be taxed by the government. That is one thing. The second thing is compliance. So how to improve the compliance rate? If you take the tax rates, for example, prior to 91, the maximum rate of taxation was about 70%. Now the maximum rate of taxation is only 30%. So the government rationalized the tax structure so as to make the people to pay taxes honestly. So now there is no incentive, there is little incentive for the people to hide the income. So when the tax rate is only 30%, many people are 10% or 20%, people will be willingly paying tax. So if it is 70%, if you don't disclose 1 rupee income, you are saving 70 paise tax. If the tax rate is only 20%, you are you are saving only 20 paise by hiding 1 rupee income. So that means you will be paying tax honestly. This is another thing which comes under the revenue policy of the government. So broadly, the objective of the revenue management is to improve the tax base of the state, and there is a norm that the taxes should be about 25% of the GDP. So the objective of the government would be over a period of time to reach that level, so that the fiscal management will be proper.
Thank you, Professor, and students who are sitting at home and watching our program. I hope you got the drift of what we have said thus far. Essentially, we started by saying that fiscal policy is a macroeconomic policy, and Professor Satyanarayana has told us that it encompasses mobilizing taxes, finally deciding how to spend the money, and in case you can't generate adequate taxes and you want to spend much more money, then you will have a deficit, and then the question arises, how are you going to bridge the deficit? Professor Satyanarayana, see, we have talked about taxes and direct taxes and indirect taxes, and the logic or the objective of these taxes is to spend this money for some infrastructure. At times it could be physical infrastructure, at times it could be social infrastructure. Could you tell our students who are sitting and watching the program at home, what is plan expenditure, what is non-plan expenditure, and which of those two expenditures should be more, if any?
Yeah. So as you have rightly pointed out, there are two aspects of expenditure of the government. One is plan expenditure and the other one is non-plan expenditure. And the students watching the program may get a doubt, and what role the planning commission and plan expenditure, all these things have in a market economy. But still government is investing in money in some of the activities to build infrastructure and to transfer funds to the state governments. So all these things, they come under plan expenditure, whereas non-plan expenditure is concerned, the broad heads of non-plan expenditure are: one, defense; another one, salaries, subsidies, and interest payments. That is what we call as servicing the debt. When the government borrows money, it has to pay interest. So that is what we call as non-plan expenditure. But a major part of the expenditure of the government goes towards meeting the non-plan expenditure, and any attempt on the part of the government to reduce expenditure, unfortunately, is cutting down the plan expenditure. That is very unfortunate. So government, as I have pointed out earlier, that in market economy the government has a little role, but still government has to invest lot of money in infrastructure projects where the private sector do not come forward to invest. Though some public private partnerships are taking place, still the government has to invest a lot of money in certain activities. So broadly the expenditure is plan and non-plan expenditure.
Thank you, Professor. So we have observed that the expenditure could be planned expenditure or non-planned expenditure, and as students of finance you already know that these expenditures could be on the current account or on the capital account. And in India, when we talk about it being on the current account, essentially we are talking about AIDS, which boils down to administrative expenses, interest, defense and subsidies. We also talk about expenditure on the capital account. So when the government spends money on bridges, on dams, on the power sector, so on and so forth, they provide utility for more than 1 year. So all in all, we have thus far discussed how do you generate the revenue and how do you go about spending money. But as Dr. Patrick would tell you shortly, we very often find that we are not able to cut our coat according to the cloth available. We try to spend much more money than the money which is available with us. So in this context, you will find that day in and night out, people talk about a concept called fiscal deficit. I would now request Dr. Patrick to demystify this concept of fiscal deficit and tell our students what it really means and how is this deficit bridged. Dr. Patrick?
Sir. Now, the gap that exists between the revenues which the government gets and the kind of expenditure, what Sir has just spoke about, the planned and the unplanned expenditure, the gap that is there is called as the fiscal deficit, and this is an indicator as to what amount of money is to be borrowed by the government, and it depends either about by borrowing from the banks or external borrowings from institutes like the International Monetary Fund or World Bank. And fiscal deficit as such is not bad in itself, and there are a few economists like John Maynard Keynes who said that presence of fiscal deficit will prevent a country from getting into recession. But if it is large and it is persistent, then it is an indicator that the government is spending a lot of money in unproductive sectors. And the other one that we have is the revenue collection, that is the tax mobilization is not done in a proper way. And in the long run, if you look at, in the past we had what is called as monetization of this debt and other things there. And it would lead to inflation, and it has its own ramifications in the form of creating unemployment and slowing down and various other things that are there.
Thank you, Dr. Patrick. That's very interesting. You know, it reminds me, you were telling us that fiscal deficit per se is not bad. It's just like saying drinking per se is not bad, but getting drunk is bad. In this context, I would ask Professor Satyanarayana, what are the implications of having a high fiscal deficit on a consistent basis?
As Dr. Patrick pointed out, fiscal deficit per se is not bad, but it is reaching alarming proportions in emerging economies, particularly in India. So we have to contain it. So we cannot go on spending much more than what we are earning for a long period of time. So we have to contain it, and the government is doing it through better targeting the subsidies, to make the subsidies reach only the targeted people and reduce the subsidies. We have seen how the government is reducing the subsidy on petroleum products, gas, etc., etc. And so these are some of the areas in which the government is trying to reduce the government expenditure. And high fiscal deficit has so many negative implications. One of the important implications is that it will result in increasing the interest rates, because that is what we call as competition between private sector and government for the limited funds available with in the market. So when both compete, the interest rates will go up. That is one of the negative consequences. And the second thing is, to the extent of fiscal deficit, the saving capacity of the people will come down, because the government is taking away that much of money from the people. That means low savings means lower investment, that again affect the growth of the country. That is the second thing. And high fiscal deficit also results in inflation, because when the supply is limited and demand goes up both from the government and the private sector, there will be lot of pressure on the available goods and services, and that result in increasing the general price level. That is another important consequence. Another important consequence is when the international agencies, particularly we have seen Standard & Poor, every time when they are going to announce the policy pertaining to rating of the countries, we are in tension whether they are going to downgrade the country country into junk status. So that will result in lot of damage to the country. That is another negative consequence of the country. And finally, it will also have an implication on the current account deficit. So high fiscal deficit will result in depreciation of our currency against the other currencies, and that will result in widening current account deficit, and ultimately it will have pressure on our foreign exchange reserves and all those things. These are some of the negative implications of high fiscal deficit.
Well, friends and students who are watching this program, we have come to the conclusion of the first part of the policy. We have been deliberating on the fiscal policy. And if I could sum up, what I would urge you before I sum up is, please watch what the finance minister, whoever be the finance minister after 2 months, will have to say about the union budget. You'll be able to appreciate the fiscal policy when you go through the budget statement. What we have said thus far, you can have an acronym for this, RED. R is resource mobilization, and Dr. Patrick told you that you could mobilize your resources either through a direct tax or through indirect tax. He amplified that a direct tax could be through corporate tax or through income tax. He then went on to tell us that the indirect tax could be through excise duty or through customs duty, sorry. Now this is the way in which the government mobilizes the funds. We then had Professor Satyanarayana telling us how you go about your expenditure, and you may have a planned expenditure or a non-planned expenditure. Professor Patrick addressed the issue of fiscal deficit, and Professor Satyanarayana towards the end told us the 3 grave consequences of having a very high fiscal deficit. One of the things which he said is the prices is likely to balloon. We'll be addressing that shortly. The second thing which he said is the savings are likely to come down. And the third thing which he said is, if you have an unsustainable fiscal deficit, then Standard & Poor and Fitch and Moody's and so many other credit rating agencies are likely to downgrade India. That would be, a sovereign rating would be downgraded. India will not be able to obtain funds from anywhere. Now we move to the second policy. We did promise at the beginning of the program that we would be talking about the monetary policy. I would urge and request my friend Dr. Patrick to tell what is a monetary policy. What are the objectives of a monetary policy? Who announces the monetary policy? Why do they announce it? Are there any tools in the arsenal of the people who announce this monetary policy? In a nutshell, please tell our students as much as you can about what a monetary policy is. So while I would urge you to be brief, at the same time, I would ask you to be comprehensive. Dr. Patrick.
Sir, thank you, sir. Now, we have just seen about this fiscal policy and the monetary policy. Now, these two policies that are there under any economic system goes about with trying to meet the economic goals of the country. And in most of the countries, it's the central bank, and in our country, it is the Reserve Bank of India, which goes about with formulating and declaring the monetary policy from time to time. And this is basically to go about with controlling the flow of money in the society, and to put a tab or check on inflation rates. It decides about the interest rates. The basic objective is to provide economic growth, to control the unemployment issue, and fixing of the exchange rates in relation to the other currencies of the countries there. These are the basic objectives, and the tools which the RBI generally uses to bring out the monetary policy is, there's one which is called as the quantitative kind of tools, which is also known as the general tools, and the other one is the qualitative tools, which are known as the selective tools. Maybe as time permits, we'll come back again to it as to what this quantitative and qualitative tools which the central bank goes about with using.
So there you are, friends. Dr. Patrick has told you that the monetary policy essentially is about the money supply. But as you are aware, perhaps, an excessive money supply might cause inflation. And inflation is a demon which nobody likes. I would now request Professor Satyanarayana to tell us what is inflation, what are the causes of inflation, what is the cure for inflation, what are the consequences of inflation, and why is it that we need to be very serious about taming inflation. Professor Satyanarayana.
Thank you. Inflation means sustained general rise in price level. So that means it should be consistently rising over a period of time. Then we call that is what we call as inflation. And there is a misnomer or misunderstanding. So if the inflation rate comes down from for example 9% to 8.75, people feel that the prices have come down. It is not correct. Prices are increasing at a lesser rate as compared to the previous period. So inflation is always measured on the basis of some base period. So as compared to the base period, what is the percentage of increase in the prices? That is what we call as inflation. And usually the inflation is measured based on the wholesale price index. That is what we call as headline inflation. And now the RBI is very much particular about the other inflation also, consumer retail inflation. That is what RBI is very much concerned about, because that is the rate of inflation which hurts the poor the most. So this is what the inflation means. And there are so many negative consequences of inflation. One of the important consequences is it increases the opportunity cost of holding money. What does it mean? For example, if you are having 100 rupees and if you deposit in a bank and if you get 6% rate of interest, and if the inflation is 7%, that means your real value of money is coming down. So that means you need to save, you need to keep more cash with you to face the challenge of inflation. That is one thing. The second thing is inflation creates uncertainty over future. So what people do is, when there is inflation, hoarding will take place. So people start hoarding the things because the price level is going up. That is another negative consequence. Then, and it discourages savings, because not only discourages, it will not, the people will not be able to save, because earlier if you are spending 100 rupees on a particular thing, now you have to spend 120 rupees. That means to that extent your saving capacity will come down. When savings come down, it will have impact on investment also. So inflation results in declined savings and low investment rate. And the impact of inflation is disproportionately more on poor. So poor are the worst sufferers in because of inflation, and that is the reason why now RBI is very much particular about containing inflation, because poor are the real worst hit because of inflation. So that is another thing. And another important thing is, now if you see, food inflation is the major contributory factor towards inflation. Even among the food items, if you see protein foods, for example milk, meat, eggs, and these, the prices of these commodities are going up, because now people are able to afford, or many people are consuming these protein items, and food inflation is causing a lot of major contributing factor towards inflation.
Professor, your thoughts on inflation are very interesting. I am sure students sitting at home have got a good idea of what inflation is, what are the causes of inflation, what is the consequences of inflation. As Dr. Patrick told us some time ago, we have to address certain issues of the monetary policy a little later. I would like to get down to this thing. How do you actually control inflation? What are the monetary tools? You talked about quantitative tools and qualitative tools. Dr. Patrick, could you elaborate on this a little bit, the quantitative and the qualitative aspects?
Sir. Now when it comes to this quantitative tools, it goes about with managing the quantity of supply of money in the society. Now when we talk about this quantitative tool, they are also called as the general tools, as I said earlier. Under this there are three of them. One is the bank rate policy, the rate at which the RBI goes about it lending to the banks. We call it as the repo rate and other things. Then the other one that we have is the variations that have been brought in the various reserve ratios. We have the cash reserve ratio and the statutory liquid ratio. Now the cash reserve ratio is theoretically maintained somewhere between 3 to 15%, and the statutory liquid ratio is about the banks will have to go about with holding reserves of foreign currency, gold, and this is somewhere between 25 to 40%. So an alteration in these ratios will go about with leading to tightening of the bank's hands, in the sense that the interest rate shoot up and there are very few borrowers, industrialization will come down, unemployment rate goes about with shooting. So there are many things which are related with these things there. And there's another one that we have, which we call it as the open market operations. And under this, what happens is the RBI goes about with the... Sir.
Yeah, Dr. Patrick, Just a moment, please. We have somebody calling us. Yes. Hello.
Hello?
Yes, please. Kindly introduce yourself.
Hello, sir?
Kindly introduce yourself.
Vijay from Vijayawada.
Yes, you are Mr.
Vijay.
Vijay.
Mr. Vijay, kindly reduce the volume of the television at home. Firstly.
Yes, sir.
Yeah.
Sure, sir.
Now, loudly and clearly, what's your question, Mr. Vijay? We are happy to.
నాకు తెలుగు చెప్పండి సార్, తెలుగు చెప్పండి సార్.
తెలుగులో చెప్పండి.
సార్ ఇప్పుడు మన అప్పుడు ఇన్ఫ్లేషన్ అంటున్నారు, ప్రైస్ రేట్ అంటున్నారు, గవర్నమెంట్ చేయలేదు అంటున్నారు. దీని నాట్ దిస్ హస్ బికమ్ ఎ బిగ్ ఇష్యూ ఇన్ దిస్ కంట్రీ, ఇన్ దిస్ పొలిటికల్ ఇష్యూ. ప్రైస్ రేట్ అంటున్నారు,
Absolutely.
అంటున్నారు.
Yeah.
ఏ గవర్నమెంట్ వచ్చాక ఎవరు కంట్రోల్ చేయరు. మన 50 ఎలా ఉందో పెరిగింది, ఇన్ఫ్లేషన్ వచ్చింది, రేట్స్ పెరిగినాయి.
You are right.
20 years is going to be the same issue.
It may be.
BJP government, Congress government.
Yeah. What is your question? What is your question, Mr. Vijay?
My question is, why do these people say so much cry about the government? Congress government is doing like this.
No, we don't want to politicize this issue. We are not talking politics here. This is a program on business environment. Thank you very much. Thank you for your question. Thank you for your question. We'll carry on with discussions here. Yes, Dr. Patrick, you were referring to CRR and SLR among other things. You told us that the cash reserve ratio will be increased in case you want to solve inflation.
So,
would you like to add something more, Dr. Patrick?
So when it comes to those open market operations, what it does is it goes about with selling its own securities. This sucks out or mops the funds that are there in the society, and there's a kind of reduction in the quantity of money that is there, and this would have a tab on the inflation. The other one that I was saying about the qualitative or the selective tools that are there, under that the RBI goes about with working out ways to ease the supply of money through fixing the margin requirements. It controls the consumer credit. It has a moral suasion, and it goes about with giving publicity of various reports as to where investments are to be done and others. Sometimes it gets into direct action in the sense to see that the banks are not having a free hand in giving loans, and there's more supply of money, and which will lead to higher inflation and other things there. Small examples like, when it comes for what should be the down payment or what should be the installment amount under hire purchase and other things, this is where the control is done. Now if you look at the way the home loans were given in the past, to an extent of 90% was funded by the banks there, but that is brought down to 80, in the sense that 20% is to be raised by the individuals to the extent which banks will not be giving. So that goes about to putting a curb on the credit. So these are some of the tools which are being used by the central bank or RBI to go about with working out for the monetary policy.
So would you agree that if we want to control inflation, one of the ways is we increase the initial installment amount or the margin money, and we might reduce the number of installments which a customer may have to pay. Perhaps these will act as a dampener, Dr. Patrick?
To an extent it goes about doing, sir. At times there are things which have to be done in the short run, and there are its implications which are seen in the long run as well there. So that does have an impact, as you have said, sir.
Fine, Dr. Patrick. Professor Satyanarayana, could you tell us, what is the meaning of expansionary and contractionary monetary policy? These are terms which again recur in the paper periodically, and this monetary policy is talked about very often throughout the year. Although it might be announced only once, or the credit policy twice in a year, people are talking about the level of money supply in an economy. So could you, for the benefit of our students, tell what is an expansionary monetary policy and what is a contractionary monetary policy?
Inflation is the result of two important factors. One is one set of factors can be termed as structural factors. The other set of factors are cyclical factors. So mostly our inflation is because of both structural and cyclical factors. So structural factors means, for example, supply side. When the supply is less and demand is increasing, so then it will result in general increase in the price level. That means
just one second. Yes, somebody wants to speak to us. Yes, hello.
Hello.
Who's speaking, please?
I want to ask a question.
May I know who's speaking, please?
I am A. Permission.
Yes.
Hello.
Yes.
I am A. Permission.
Yes. Please.
Speaking from Patna.
Okay.
I want to ask a question in the program.
Please ask us the question.
How exactly inflation is calculated?
How exactly inflation is calculated?
Yes, so for a common man, I want to understand how it is.
It's a very simple thing. They take an assortment of commodities or products which is consumed by the average person. They assume that, look, there is a family and there are 2 or 3 people staying there. How much is the level of food which they consume in a year? If you are familiar with a thing called index number, you will be able to understand very quickly what is a consumer price index.
Okay.
So when you talk about inflation, we would take an average family. We will try to find out what is the consumption of cloth by the family. We will try to find out what is the consumption of food grains by the family with reference to a certain year. And then later on, what is the price of the same quantity of goods and services? In case they have increased, we would say that, look, the CPI has gone up. But having said that, I would now request Professor Satyanarayana to add to what I have said.
Now, there are 2 important ways of calculation of inflation. One is based on wholesale prices, the other one is based on retail prices. In wholesale price based inflation, most of the services are excluded, because in wholesale price we don't take the services into consideration. But as you are aware, now a major part of our expenditure is towards services. For example, a person who is earning a salary of about 30 to 40,000 rupees per month, he spends about 10% of his income on food and other things. But whereas a major portion is spent on services, for example house rent, or you take cable connection, newspaper, all these are cell phone, all these things, they are taking a lot of money from the individual. So retail inflation takes services also into consideration. As Professor Narendranath pointed out, inflation is calculated on point to point basis. For example, at this point of time, last year, what is the price, what is the index, and now what is the index? For example, earlier if the index was 120%, and now if the index is 125%, we say that the prices have gone up by 5%. So we construct an index taking base year prices as 100, and on that we calculate the increase in the price level, and that is how the inflation is calculated.
Thank you, Professor, and I hope the caller from that place is happy with the answer which we have provided. Professor, you were talking about expansionary and contractionary monetary policy. You could now tell us what is a contractionary monetary policy.
Yeah, so expansionary monetary policy is adopted by the Reserve Bank of India when the country is in, as I have already pointed out, there are 2 important reasons for inflation. One is structural, the other one is cyclical, and monetary policy mostly helps in containing the inflation, which is because of the cyclical factors. So RBI has very little role as far as structural factors are concerned, because that is the decision of the government how to improve the supply of the goods and services in the economy. It is not under the purview of RBI. Though monetary policy helps in improving the investments, and indirectly it helps in growth, but directly RBI may not influence the growth rates. But as far as the cyclical situation is concerned, when the country is in recession, RBI intervenes to improve the availability of money in the economy, so that investments will go up, and the economy will revive, employment will go up, etc. That is what we call as expansionary monetary policy. And now we are seeing contractionary monetary policy. Though it is paradoxical, the growth rate is less, but still the inflation is very high, and RBI's main concern is now how to tackle the inflation, because as we have already discussed, inflation hurts the poor the most. So inflation must be the top priority of any government that is in power. So RBI, if the RBI's policy is to contain inflation and then increase the repo and reverse repo rates, and that's how the interest rates in the economy are impacted by the RBI policy, that will result in reduced expenditure, and that will also result in decrease in inflation.
Thank you, Professor. I have one more question to you on the monetary policy. You know, sometime back I read an article and I was not able to get my arms around a concept called growth inflation dilemma. I am just wondering whether you could throw some light on what is growth inflation dilemma.
Yeah. So there are so many studies which showed that there is a positive inverse relationship between inflation and growth, particularly after a particular level. As Dr. Patrick pointed out, per se fiscal deficit is not wrong. Similarly, inflation also up to a particular level it should be there. Otherwise, the economy will not expand. So inflation beyond a particular level, it is very bad. So beyond that particular level, there is a negative relationship between inflation and growth rate. High inflation result in lower growth rate. So we have to target the inflation to improve the growth. But the thing is, when the RBI adopts a policy of as he rightly pointed out earlier, pertaining to expansion and contraction, so that in a situation where RBI is trying to manage the monetary policy to reduce, to increase the interest rates and reduce the availability of money in the market, in such a situation, the what some of the economists feel is when the investments will come down, and when investments come down, employment will come down, and that will affect the growth. But the RBI's concern is, unless we tackle the inflation, we cannot have a sustained growth. So growth, another important thing is, we don't have a target on growth rate. So what is the expected growth rate? Should it be 10%? Always is it possible for the country to achieve a growth rate of 10%, 9%, and is it sustainable? And what is the sustainable growth rate of the economy? That we must be concerned about that. So when the growth coupled with lower levels of inflation, that will result in a sustained growth over a long period of time.
Yes, I think we're having another caller. Hello? Hello?
Hello.
Yes. Who's speaking, please?
Good afternoon. This is Kalyan from Vizag.
Yes, Mr. Kalyan.
Sir, I have small question, sir.
Yeah, go ahead.
Sir, what will be the expected inflation rate in the next 20 years?
In the next 20 years, I mean, see, you know what J.M. Keynes said, in the next 20 years means in the long run. In the long run, all of us are dead. You have to ask us what is the inflation rate after 2 weeks or 2 months.
Yeah.
Anyway, the RBI is targeting at an inflation rate of 8% by January 2015. And as Professor S.V. Satyanarayana told you just now, of late we are having this concept called inflation targeting. You had a committee called the Urjit Patel Committee, which submitted its recommendations very recently. The RBI has accepted the recommendations, and like New Zealand, which introduced it in 1990, we are contemplating that we will be able to have inflation at around 8% by Jan 2015. And I am talking about the retail price, not the wholesale price.
No, I will add
Yes,
one more point to what Professor Narendranath has explained. So that in the long run, the target should be around 4 to 6%. So inflation should be around that. So if it exceeds 6%, it will be, it may not help the economy.
So thank you, Professor. We have yet another caller. Hello.
Hello, sir.
Yeah, speak loudly, please. Introduce yourself.
I am a senior officer from Hyderabad.
Mr. Rao from Hyderabad.
Yes, sir.
Yeah, go ahead.
What is the velocity of money supply system? How the velocity is measured, sir?
That is out of our
You want to know what is the velocity of money?
Money supply.
You see, velocity of money, I think Professor Satyanarayana would...
No, it is out of the purview of our discussion. We are discussing the policies of the government. So that calculation of velocity and all those things you will study in money, banking, international trade, and all those subjects. And here we are discussing only policy issues.
But having heard that, I'll just chip in with one more statement. Suppose if you have 10 rupees with you, and then you give it to the conductor, and he gives it to his wife, who goes and buys vegetables, and she gives it to her daughter, then the velocity will be 4. So the number of times money moves from one person to another is velocity. But as Professor Satyanarayana said, we would urge students, we would urge participants and friends watching our program to stick to the subject, to ask us questions pertaining to what we are discussing. I think we're having another call. Yes, hello.
Hello.
Yes, please.
Yes, I would like to ask the
panelists.
Ask the panelists on the Urjit Patel Committee's recommendation.
Right.
Because
I've just told you, and the panelists will concur with me.
Urjit Patel Committee is, and
yeah, I'll tell you. See, I'm sure Professor SVS and Dr. Patrick will concur with me, but essentially the Urjit Patel Committee has said that, look, we need to have inflation targeting. And we also need to use what is called retail price index rather than wholesale price index. They have made a few other suggestions, but some of the suggestions are yet to be accepted by the RBI. Thank you very much for calling. We'll now move to Dr. Patrick. I want to ask you of Dr. Patrick, look, is this fiscal and monetary policy complementary, or are they isolated? Are they separate?
Sir, from the beginning we have been holding it, saying that the fiscal policy and monetary policy, these are two policies which the government goes about using to reach its economic goals. One is administered by the government and other by the RBI. And the fact remains, if
Patrick,
you go...
one second.
Yes,
Somebody else wants to speak to us. Yes, hello.
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 Hi, my name is Ranjit, calling from Bangalore.
Yes, Ranjit.
I have a question. I mean, you are talking about economic policies, right?
We are talking about fiscal policy and monetary policy. You're right.
Exactly. So I have a question. Who formulates these policies? Is it the government which does it, or the SBI is independent body which does it?
You will hear an answer from Professor Satyanarayana in a second.
Monetary policy is governed by RBI. It has autonomy. Even government cannot interfere with the monetary policy. Government can only express, it may tell something, but RBI need not listen to the government as far as monetary policy is concerned. We have seen recently when Chidambaram says that growth is our target and RBI is not reducing the interest rates, and governor of RBI said no, our inflation is our target and we cannot do that. And as far as fiscal policy is concerned, there are so many compulsions on the to the government. So for a political compulsions, though the government wants to reduce the expenditure, it may not always be possible for the government to reduce the expenditure because of political compulsions, particularly during the periods when the budget is presented before elections, etc. They have to go by such considerations.
Thank you, Professor. And Ranjit from Bangalore, I hope you got the answer. We have another phone call. Yes, hello.
Yeah, hello.
Yeah. Who is this?
Yes, good afternoon. This
Good
is
afternoon.
Swaraj.
This is Parag, is it?
Yeah, this is Swaraj.
Yeah.
I want to know the relation between inflation and this thing, recession.
Inflation and recession.
Yeah.
Okay.
No. Recession means contraction, inflation means expansion. So there may be a situation where we may simultaneously find both the inflation and recession, that is what we call as stagflation, where the economy is slowing down, but we find the prices to go up because of the supply side constraints. So such situation we too have faced in our country. So that is what we call as stagflation. Coexistence of both inflation and recession, we call it as stagflation.
So Parag, to continue with what Professor Satyanarayana has said, you see, inflation is increase in prices, deflation is decrease in prices. Okay, recession is when there is a decrease in the GDP for 2 successive quarters, and in case it becomes more aggravated, then it's called a depression. Somebody said in a lighter vein, if your neighbor loses the job, it's recession. If you lose your job, it's depression. Oh, by the way, we have another caller. Hello. Yeah, we can't hear you. Firstly, you have to reduce the volume of your TV at home. No, you're not audible at all.
Hello.
Yeah.
Hello, sir.
Yes, hello. What's your question?
My name is Gene Alapreddy. I'm calling from Hyderabad.
Mr. Reddy, what's your question?
My question is, I just want to know the simple answer for this question, sir. How is RBI minting money? What is the equation for minting money, sir? So how much amount are we minting money every year? So what is related to this? Somebody told me that we mint money according to the gold reserves of the country.
Okay.
So can you please elaborate on this?
So sometimes the government the deficits, some of the deficits, fiscal deficit of the government results in monetization. So that is what we call as monetization of deficits. So that results in expansion of money supply in the economy, and that causes inflation. So as you have rightly pointed out, there should be a match between the availability of liquidity in the system and the supply of goods. Sometimes the liquidity will be much more than the supply, that results in inflation.
I hope you got your answer, Mr. Reddy. We have another question from somebody else. Who is this, please? Hello.
Hello.
Yeah.
My name is Srinivas, sir.
Yes, Srinivas.
I want to tell thanks to Dr. Satyanarayana.
Yeah.
I learned about inflation and recession.
Fine. We're glad that not only you but so many people across the nation in Bangalore and in other places, they're getting a good idea thanks to my friends out here. Thank you very much for calling.
Your team members, sir.
Yeah, thank you very much. Thank you very much. Do you have any question?
I don't know, sir.
Yeah, fine. Thanks for calling. Right? Keep watching our programs. You're only more than happy to know that many people are watching our program. So let's move on. We have discussed thus far the fiscal policy and the monetary policy. We would now move to the financial sector reforms, and I would now call upon Dr. Patrick to tell us what is the need for financial sector reforms. Oh, before you answer that, Patrick, we seem to be having too many questions today. Sorry, Patrick. Yes, hello.
Hello.
Yeah.
Yeah, this is Bhaskar from Bangalore.
Yes, Mr. Bhaskar.
Yeah, I have a question. The question is regarding people these days they buy a lot of gold.
What are you talking about?
Gold.
Yeah, they buy a lot of gold and now they electronic bag gadgets, and then everyone they feel like that's the minimum thing they need it.
Oh.
So how does this affect? I mean, how can this be controlled and how can this affect the inflation?
Are you talking only about gold? Are you talking about Bitcoin or something?
Gold.
Gold.
You're talking only about gold.
I'm from Andhra, because from other people, a lot of people buy.
Yeah, across India, everybody buys gold. Gold is a good investment. You're right. Put your money in that. But Professor Satyanarayana will amplify whatever you want to know.
Gold, we don't have adequate production of gold in the country. Mostly gold is imported. So we import gold from other countries, particularly South Africa and other countries. So import of gold results in higher current account deficit. So when the gold imports are higher, current account deficit will grow. That is what we have seen in the recent times. So that is the reason why government has taken a decision to put some curbs on gold imports. So that resulted in increase in the price of gold in the country. Though generally the price of gold has gone up, and the price of gold is related to the functioning of American economy. If the American economy is doing well, gold prices come down, and if the American economy is not doing well, people will shift their money from other investments to gold investments, and which they feel as safe. So your point is, what is the relationship between gold, buying of gold and inflation? There is no direct relationship between buying of gold and inflation, but there is some indirect relationship. When people buy gold instead of putting the money in productive investments, to that extent the investments will come down, and in the long run production may come down, and that may have indirect impact on the growth of the economy.
Thank you, Professor. But Dr. Patrick, you have to hang on for some more time. We have another caller. Yes, hello.
Hello.
Yes, please.
Yeah, this is K.M. Rao, speaking from Bangalore.
Yes.
My question is that inflation can be fixed only by monitoring and changing the repo charges alone, or is it only quick fix solution? Is there anything else which should be done in long term? Is the question.
Long term for what?
To contain inflation. That is what I think you are asking about, containing inflation.
Exactly. To contain inflation.
What is the long term policy?
Yeah.
So in the long term you have to manage the supply side. So in the short term you are managing the demand side. So supply side constraints are the important reasons for inflation in the country today. That is what the government is also saying. So supply side means you have to improve the supply of goods and services in the economy. So that is the only solution in the long run.
Fine. Let's move on to another question. Somebody else is calling us. Hello.
Hello.
Yes, please.
Vinata, good afternoon, sir. I am one of the students from IP, sir.
Good afternoon. What's your name?
Karthik Kulkarni, sir.
Karthik Kulkarni. What's your question, yes. Karthik?
Sir, there are many tools in controlling of monetary policy like CRR and SLR and OMO.
Indeed.
But on what basis RBI will select from those tools? My doubt is that, sir. On what basis RBI will select the tools?
On what basis CRR they will prefer to go either for CRR or SLR, yes. Right?
Or OMO.
No, the government of the day, that means the Reserve Bank of India, will take a call or make a judgment. It will decide whether to increase the CRR or to increase the SLR. Sometimes they may not do either of them. It depends upon what exactly is happening in the society as such. Professor SVS, you would like to add?
Another call is also.
I'm sorry, I'll answer this question when we meet up in IPE. Sorry about that, Karthik. We have another caller. Hello.
Hello, sir.
Yes, please.
హలో, నా పేరు శ్రీవాణి అండి. తెలుగులో మాట్లాడొచ్చాను.
తెలుగులో మాట్లాడండి శ్రీవాణి.
అవునండి. ప్రస్తుతం ఇన్ఫ్లేషన్ గురించి చెప్తున్నారు కదా, ఎడ్యుకేషన్ ఫీల్డ్ లో ఇన్ఫ్లేషన్ రేట్ ఒక 15 years తర్వాత ఎలా ఉంటుందో చెప్పగలరా?
You are not paying attention to what we are talking. We already answered that question, Srivani. But nevertheless, Professor S.V. Satyanarayana will tell you because you're the first girl who is talking to us.
మీ ప్రశ్న అర్థం కాలేదు. అంటే ఎడ్యుకేషన్ ఫీల్డ్ ఇన్ఫ్లేషన్ అంటే కొంచెం ఎలాబరేట్
ఉదాహరణ ఇవ్వాలా దానికి? ప్రస్తుతం ఉన్నత విద్యాల్లో ఇప్పుడు ఎవరైనా చదవడానికి ప్రయత్నిస్తే ఇప్పుడుండే ఇన్ఫ్లేషన్ రేట్ 6% తీసుకున్నట్లయితే ఇప్పుడు ఒకవేళ వాళ్ళు 5 లక్షల ఖర్చు పెడితే మీరు అనుకున్నట్లు ఇప్పుడు వాళ్ళ పాప 2 సంవత్సరాలు ఉంటే హైయర్ ఎడ్యుకేషన్ వయసుకు వచ్చే వరకు దాదాపుగా అది 20 లక్షల వరకు అవ్వచ్చు, 20 లేదా 32 లక్షల వరకు అవ్వచ్చు.
I hope you got your answers, Srivani. I would now urge Dr. Patrick to tell us about the financial sector reforms very quickly. The reason why I am asking you to do that is we have very limited time.
Sir, the finance sector is considered to be the backbone of economy in any country there. And the finance sector comprises of the banking, financial institutions, the various instruments and the markets we have. And during the 1990s we have gone about to witnessing that there was extensive regulations that were there. There was administered interest rates that were there, weak banking structure, lack of proper accounting and risk management systems, lack of transparency in operations. And over and above there was this balance of payments issues that were there, and there were committees that were being set up and reforms were being introduced. It was done in 2 phases. One was done in the early 1990s, another one in the mid 1990s. Probably Professor S.V. would speak about what those reforms were.
Yes, Professor, in 30 seconds flat, could you tell us what are the major recommendations of the Narasimham Committee?
Narasimham Committee was appointed to look into the banking sector reforms and financial sector reforms. And as far as banking sector reforms are concerned, Narasimham Committee made some useful suggestions, and most of the suggestions were recommendations were implemented. For example, one of the important recommendations is to give more freedom to the banks, particularly in fixing interest rates. Now you see on savings bank interest, the banks have freedom to fix the interest rate. Some banks are giving 6% interest rate on savings bank, etc. That is one thing. And the Narasimham Committee made another useful suggestion pertaining to classification of assets. So how to provide for that?
I'm sorry, Professor Satyanarayana, I wish you could continue, but unfortunately we don't have any time. I've been warned by the people in the studios, we run out of time. I will try to recap what we have done in the last 1 hour or so. Essentially we have discussed 2 or 3 policies. We tried our best to tell you what is the fiscal policy and what is the monetary policy. I hope all the people who have been watching our program have been enlightened. We're absolutely delighted at the number of calls we had from various places. It encourages us to participate in such programs and deliberate in these things. On behalf of the viewers and on my own behalf, I'd like to thank my friends Professor Satyanarayana and Dr. Patrick for having shared their views and thoughts with us. I would also like to thank all the viewers for having watched our program and for having asked all those questions. But before I sign off, I'd like to remind you, don't forget to be awesome. Thank you.